So I know I said I was not going to post a video till the new year. That was my plan, to take a full week off of YouTube just so I could relax, decompress, take kind of, more or less a little mental break. But I can't do it. I can't stop filming videos. I was sitting at home getting super antsy. I was telling myself I feel so unproductive. I was getting kind of bored. And that's why we're here today, to come bring you guys a little bonus video for 2020. This is going to be nothing crazy, but I did want to share with you actually a couple stocks that I added to the portfolio today. So these are 2 stocks to buy, essentially. 2 stocks that you guys should look into if they suit yourselves. These are 2 stocks that I added, and actually share with you more or less some decisions that I made in the background with my portfolio. Hopefully it can be a little bit of a lesson on actually what this is rebalancing 101. It's configuring your it's moving money around and kind of shuffling some things, because that's what we did. Because today the stocks that we're going to talk about are carrier stock. There's 4 stocks: carrier stock, Otis elevators, Alibaba stock, and then Tencent. And what are the correlation with these stocks today? Well, actually, I ended up selling 2 of them and taking that money to deploy into 2 others. And you may be guessing already, there's a lot of talk going on along with Alibaba, for example, because that stock's down about 30% off highs. There's some tension going on with China at the moment, and we'll speak on that in just a second. But keep in mind, this is just what I did for my portfolio. I could very well be wrong. I could be wrong. This could be a terrible move. But what I decided to do was actually trim from 2 of my well-performing positions. For those of you that don't know, Carrier stock, they're the company that makes HVAC systems. They make air conditioning units, etc. They're quietly up over 200% year to date. And it's funny, that stock doesn't get covered on YouTube, but it's doing very, very well. Even Otis is a stock that's up nearly 50% since the spinoff. These are 2 companies, just FYI, if you're not familiar. They spun off from United Technologies. So that's why I own these shares. I used to own UTX, and they spun off into 3 companies: Otis, Carrier, and then Raytheon, which is another stock that I've been buying. And Raytheon had been performing poorly, whereas these other 2 companies actually have been doing very, very well. They've been really running with the market. And the thought process that I made here, maybe a controversial one, but again, this is just my strategy. This is what works with me. I decided to actually trim from the winners, actually take profits and actually sell off these positions, and then use that capital to go deploy into a couple weaker areas at the moment, which happen to be the Chinese stocks, which happens to be Alibaba, which I own, which happens to be Tencent, which I own. And that actually sparks like a very interesting discussion for today's video. Is that a mistake? You'll hear people argue very strongly that you should never trim from your winners. Don't trim from the winners. Don't harm them. They're doing well for you. Why would you basically cut out of the winning positions and then reward the losing positions? And that's a very fair argument. This could actually turn out as a backfire for me if we check back a few months down the road or a year down the road and Carrier continues to perform well, Otis continues to grind up, and there's still a lot of issues with China, because the reality is there is a lot of uncertainty when you invest in China. They come at a higher risk. But again, these are just decisions that I made for my portfolio, because to me, given my strategy, given my risk tolerance, where I assess I am in life and my investing cycle, I feel that I can be a little more aggressive. I don't feel that I am. I can be more aggressive for a variety of reasons. And to me, I have no issue investing with China. Again, that's a topic for another video if you're for or against investing in Chinese companies. But companies like Alibaba and companies like, I always like saying Alibaba. I always say it's so funny, Alibaba. Companies like Alibaba and Tencent are so well positioned, in my opinion, for growth. When you factor in just the growth and the expansion of China in general, how strong this economy is going to grow over the years, along with the fact that they're both digital companies. They're both in e-commerce. They're both in a space that is very, it's a great space to be in. They have a lot of tailwinds, essentially helping to bump these companies forward. And that kind of leads me into the thought that there's no question right now that these big Chinese companies are under a bit of scrutiny because of there's a lot of tension growing with the government, or what they're putting a lot of pressure on these big companies. There's no question that that's a legitimate concern. But what I often feel is that when these legitimate concerns happen in the market, investors in general, tend to overreact a little bit. Don't get me wrong, there's reason to sell off, but often it's a little more amplified than it should be. And as a long-term investor, if I do believe in the long-term prospects of a company like this, I feel that investors can actually take advantage of that by almost buying in on these dips. Again, it has to be a strong company that we're talking about here. And in both cases, I really do believe that's the case. So why did I decide to trim from Carrier? Well, Carrier in particular is one that I was looking at because, I mean, yeah, they've done super, super well. And anytime a stock goes up like 200%, first of all, it does get me thinking. It gets me thinking, like, is that justified? Is that realistic? Is that too much? Is there still room to go? So right away, it was up on my radar as a stock to kind of watch in my portfolio. They did actually just increase their dividend by 50%, which is another positive. So I'm like, okay, well, that's a good sign. That's a good sign. But I did take a look deeper. And one of the things that did kind of not concern me, but something to think about was that they have seen their debt creep up. So for example, we see their debt to capital ratio has increased to about 70% of capital. Another one that I look at is debt to EBITDA. That's up at 5.9 times. EBITDA, by the way, think of it basically as earnings. I've gotten questions before on that. Earnings before interest, taxes, depreciation, amortization, I believe it is. The way I like to look at it is that all companies have their own unique tax structure. They all have their own unique everything going on internally within the company. So it's very hard sometimes to compare apples to apples with companies if you're just looking at bottom lines. But EBIT or EBITDA basically looks at the earnings before subtracting out those other things, before taking away the individual tax rates. And I mean, some companies may be based in Ireland, some companies may be based in US, and they pay different taxes. So it's not a fair comparison. EBITDA basically just tells you more of an apples to apples comparison, what the earnings were before they took out their individual unique company specific things. But anywho, that's creeped up to about 5.9. I looked a little bit deeper into the balance sheet and saw that over the past number of quarters, cash has grown. It grew from 952 million up to 3.8, which is fantastic. This is as of September 2020. But then you also see along with that, the debt has increased. So total debt has gone from 682 million up to today at about 12.6, or I should say as of September 30th, up to 12.6. So it's not to say that I think debt in this case is going to be a detriment to this company. In fact, you could argue debt right now is super cheap because of interest rates. It's not a terrible thing for companies to hold long-term debt. That said, I factored that in, just the growing debt, along with the great performance, along with the profits that I made. And I thought, not to mention that as much as I love Carrier and it's been a great stock for me, it's not like I wouldn't die if the stock was not in my portfolio. There's other companies that I personally would rather invest in from a company standpoint. All those combined had me decide maybe it's not a bad idea to take those profits, lock them in, and then redeploy that into a weaker area. And that's more or less actually the topic of today's video. I know that's so simple, but again, it's almost two-pronged. You have the two stocks that I'm liking in Alibaba and Tencent, because to me, I think those are two very powerhouse companies. When you look at any of the growth metrics, it is a very promising space to be in. Tencent's a stock that I've been talking about since I started this channel. Actually, believe it or not, it was one of the first stocks that I ever covered, dating back to whenever that was, 2017 or 2018. So yeah, it's been one of my all-time favorites since then. And more or less for this video topic, just comparing that up with the rebalancing idea, you can always, shuffle money around in your portfolio. It's very, very easy to do. It's just when are the most opportune times? This to me was actually a pretty clear case where I had a stock that did super well. Why not take the profits? Why not deploy that into a weaker area? And let's assume the tides turn. I'm not expecting that, but let's assume Carrier drops down because the markets feel that it's a little overheated. Let's assume they also start to pick up with the Chinese stocks. Well, then I did a great job of reallocating my capital. It's kind of like a constant shuffling game of what's done well, where can I deploy that into a weaker area? And you're constantly reshuffling your capital in that sense. But yeah, that's the video today, guys. Like I said, just a short one. Just want to kind of almost check in. Hopefully everyone's had a Merry Christmas and a happy holiday season. I will be taking a break now until the new year. What do you guys think about the whole deal with Alibaba, the whole deal with Tencent? There's a lot of talk right now with whether these are stocks to buy, whether they're stocks to avoid. Personally, for me and my experience with Chinese stocks, I've gone through so many cycles already, even in just a couple year holding period of Tencent going, so much negative news. And now they're, crapping this division, video game division sucks and China's going to do this and that. And you know what? You do see the overreactions temporarily, but at the end of the day, I think they are a little bit overblown, and it's a good chance to look at these stocks. Keep in mind, these are just stocks for me that work for my portfolio. They very well may not be a good stock for you, and maybe you can't even buy the stock. Tencent trades over the counter, just FYI. So depending on what platform you use, what brokerage you use, they may not even let you. But that's it for today's video. If you guys enjoyed, give this one a thumbs up because that is a great way of supporting. If you're not already subscribed to the channel, you're watching this video, subscribe. We post videos every week like this. And then of course we do have our investing academy. So if you are a beginner to the stock market and you want courses, training, we actually had this entire discussion within our group today. That's actually what sparked my topic for this video. We were literally having this discussion within our community. And that's of course one of the features you get if you join our academy. There's a link down below. As always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.